Good afternoon, everyone. Welcome to the third session of the Overseas Market 2025 Investment Strategy Conference, focusing on the dual recovery of Southeast Asia's economy and finance. Hello, everyone. I'm Shelley, and I have the pleasure of being the special guest for this session today. Can everyone hear me clearly? All right, let's officially begin this exciting live broadcast for everyone watching. First, let me briefly introduce the main content of this live broadcast, which you can see in the outline. This session is mainly divided into 5 parts. First, we will address the question, why should we focus on Southeast Asian economies? The second part will thoroughly review the emerging trends in the Southeast Asian stock market for the year 2024. The third part will thoroughly analyze several key factors significantly affecting the Southeast Asian market landscape in 2025. Next, the fourth part will thoroughly discuss the strategic allocation of major assets in Southeast Asia. Finally, the last part will be our Q&A session. All right, let's get to the main topic. First, allow me to pose an important question. Why should we truly pay close attention to the rapidly growing economies of Southeast Asia and their impact on the global market? In the previous 2 informative sessions, you learned about the macroeconomic environment in both the US and Europe, along with various strategic directions for effective asset allocation. So, besides the United States and Europe, why should we also place significant focus on the rapidly growing Southeast Asian market? First, let me briefly introduce and highlight the key characteristics of Southeast Asian economies. In this live broadcast, we will mainly refer to Southeast Asian economies as ASEAN. First, let me introduce ASEAN, a vital trade and economic entity composed of 10 diverse member countries in Southeast Asia. These include Brunei, Cambodia, Indonesia, Laos, Malaysia, Myanmar, the Philippines, Singapore, Thailand, and Vietnam. As you can clearly see on this detailed map, the precise locations of these specific countries are marked. You can clearly observe that numerous countries exhibit certain characteristics commonly associated with island nations. The distribution of these countries is quite scattered across the region. However, Myanmar, Laos, Cambodia, and Vietnam are positioned relatively close together, forming a cluster that distinguishes them from the more widely spread nations in their vicinity. Island nation traits are evident in countries such as the Philippines, Brunei, Malaysia, and Singapore. According to a comprehensive report released by a prominent Malaysian investment bank, it is projected that by the year 2025, the combined GDP of Malaysia, Indonesia, the Philippines, Singapore, Thailand, and Vietnam will continue to sustain a healthy economic growth rate of approximately 4.7%. The report points out that with the further boost in manufacturing and exports represented by electronic products and the structural upward trend in attracting foreign direct investment, the data centers in the ASEAN region are expected to develop rapidly, and the tourism industry will continue to recover. Additionally, the impact of a series of favorable measures introduced by China is also significant. The economies of these 6 ASEAN countries are anticipated to maintain their resilience and continue achieving steady growth in the coming years, supported by favorable trade conditions and regional cooperation. This is our general direction, indicating that the economic prospects of these countries are quite promising. Next, let's thoroughly discuss why we should pay close attention to the rapidly growing Southeast Asian economy by highlighting a few key points for consideration. First, let's take a look at this chart. This chart displays various macroeconomic data that was released by ASEAN in the year 2023. First, when examining the population numbers and analyzing the population density, it is clear that Indonesia holds the largest share of the population within ASEAN nations. As we know, the Association of Southeast Asian Nations, ASEAN, stands as the 3rd largest economy in the world, based on its substantial population as of 2023. Notably, Indonesia's population within ASEAN ranks 3rd, being surpassed only by the much larger populations of India and China. Among the member countries, Indonesia, the Philippines, and Vietnam rank in the top 3. Countries with populations over 100 million exist. However, we see that although these 3 countries together dominate in terms of total population numbers, Singapore uniquely leads the world in terms of its impressive population density. It has the highest population density. Furthermore, by closely examining the population structure, we can thoroughly analyze the distribution of individuals aged 65 and above, alongside those within the younger age group of 15 to 29. In 2023, the demographic structure of ASEAN reveals a significant characteristic, highlighting a notably youthful population profile across the region. The proportion of the population aged 65 and above is currently only about 20%, while a significant 60.58% of the population belongs to the youth category, specifically those aged 15 to 29 years old. Among this vibrant and youthful population, the Philippines proudly ranks first, while Malaysia holds a commendable position in third place. These two countries boast a relatively high proportion of young people, in contrast to Singapore, which has the lowest percentage of its population classified as aging. The proportion of the population aged 65 and above reaches 44.60%. So these are the 2 points. One is that ASEAN's population ranks third globally, and the highest population density is in Singapore, and the other is the youthful population structure. Malaysia boasts a significant proportion of young people, whereas Singapore currently has the highest level of aging citizens. The third point is that we can clearly observe the steady recovery of the Southeast Asian economies following the challenges posed by the COVID-19 pandemic. Let's first take a closer look at the detailed chart on the left side. This is a distribution of the year-on-year GDP growth rates for ASEAN. Since 2012, the overall average GDP growth rate of the ASEAN region has consistently remained within the range of 5% to 6%, reflecting steady economic development and resilience across its member countries. There has been absolutely no sign of any slowdown. After the pandemic, a swift and remarkable recovery was also achieved. Now that we've looked at the overall situation, let's examine the GDP of the member countries. In 2023, Malaysia and Singapore's per capita GDP significantly surpassed the overall economic level of the ASEAN region. Among these countries, Singapore boasts the highest proportion of its GDP derived from the service sector, exceeding 76%. Next is the Philippines. Malaysia ranks fourth. According to the latest data, in the third quarter of 2024, Singapore's GDP growth rate reached 8.19%, while Vietnam and Malaysia also exceeded 5%. These countries have experienced remarkable and rapid economic growth since the year 2013, which has significantly transformed their financial landscapes and improved living standards for many of their citizens. Having looked at the economy, let's take a look at trade. We can clearly see that ASEAN's trade is strategically divided into services and various goods categories. Among them, trade in goods represents a substantial share of overall economic activity. From the perspective of this trade, the primary export destinations are predominantly located within the ASEAN region, while China continues to hold the highest share of exports externally, reflecting its crucial role in international trade networks. As for import destinations, the largest share comes from China. Next, focusing on ASEAN, it is evident that the trajectory of trade in goods within the region is primarily fueled by strong domestic demand. The second important aspect is exports to China. Now, let's take a closer look at the specific categories of goods that are traded internationally. The category with the highest proportion of trade volume is primarily electrical and mechanical equipment. This includes recording devices, televisions, audio and video equipment, copiers, and their parts. The second category is mineral fuels, mineral oils, and distilled products. From the perspective of various service trade categories, it is important to note that both exports and imports in the realms of transportation services and tourism activities hold a significant and substantial share in the overall trade landscape. To summarize this characteristic in one sentence, ASEAN's service trade share is lower than that of goods trade, with transportation and tourism dominating the industry. This is the fourth and final characteristic identified. Now for the fifth point. Having discussed trade, let's talk about ASEAN's position in the global investment landscape. as we can clearly see in the year 2023. In fact, since the year 2022, ASEAN's overall share of foreign direct investment has remained both high and stable, indicating strong economic interest and confidence in the region's markets. The share of investment coming from within ASEAN countries accounts for only 9.5%, while the vast majority of investment originates from sources located outside the ASEAN region. Globally, the largest amount of foreign investment flowing into ASEAN nations comes from the United States, highlighting its significant economic presence. Next is Europe, where mainland China accounts for only 7.8%. From an industry perspective, the service sector has the highest share of foreign direct investment, exceeding 73%, followed by manufacturing. Agriculture only accounts for about 1.1%. It's quite clear that everyone recognizes that ASEAN's investment landscape is primarily dominated by the service sector, which plays a crucial role in the region's economic development and growth opportunities. In terms of domestic investment, the country with the highest foreign direct investment share in 2023 is Singapore. Its share mainly comes from external sources, accounting for an absolute advantage of over 97%. In comparison, what about Malaysia? When compared to Singapore's impressive year-on-year growth, Malaysia's share of foreign direct investment in 2023 has unfortunately decreased by nearly 50%, indicating a significant decline. However, this country's share primarily originates from within ASEAN, accounting for a significant 56.5%, correct? You can easily observe the clear and distinct differences between Malaysia and Singapore in various aspects. One's foreign direct investment mainly comes from outside ASEAN, while the other mainly comes from within ASEAN. The sixth point we previously mentioned highlights the current situation of transportation and tourism within the broader service sector. In the ASEAN region, we can clearly see that the service sector accounts for over 50% of GDP, with tourism playing a significant and major role in service trade. From this comprehensive table, we can clearly observe that transportation and tourism stand out as distinctive and vital features of ASEAN's primary import and export service industries, highlighting their significant roles in facilitating trade and contributing to the region's economic growth. In 2023, inbound travelers to ASEAN increased by 133.9% compared to the previous year, highlighting tourism growth. Among these visitors, approximately 40% are tourists coming from within the ASEAN region. In terms of transportation, the total number of tourists entering the ASEAN region by air has reached an impressive 213 million, with Thailand, Malaysia, and Singapore proudly ranking as the top 3 destinations for visitor numbers in this vibrant area. Year-on-year growth rates compared to last year are 152%, 100%, and 115% respectively. It can be seen that among the member countries of ASEAN, the characteristic of being a tourism country is very prominent. The 6 key points outlined above illustrate the important reasons why we should closely monitor and pay careful attention to the evolving situation of Southeast Asian economies and their potential impacts on global markets and regional stability. Next, let's take some time to thoroughly review the performance trends of the Southeast Asian stock market throughout the year 2024. The previous section primarily discussed the ongoing economic recovery and the fundamental aspects of the overall economy. Next, we will closely examine the overall performance of the financial market in detail. All right, let's take a look. First, from this detailed table, we can clearly observe that in the first half of 2024, the ASEAN emerging markets contributed significantly to overall growth. The FTSE ASEAN All-Share Index, which excludes developed markets, clearly demonstrates this trend and its implications for investors. In the first half of the year, it rose significantly by 7.4%, and furthermore, large-cap companies operating within the ASEAN market demonstrated even stronger performance, surpassing expectations and contributing positively to overall market trends. The FTSE ASEAN 40 index saw a significant increase of 14.85%, while the Dow Jones ASEAN Top 100 Index experienced a notable rise of 10.94%. Secondly, among the member countries in the organization, we can clearly observe those that have achieved significant gains and improvements since the beginning of this year, showcasing their economic resilience and growth strategies. It is owned by both Malaysia and Singapore nations. We can clearly observe that the FTSE Singapore Straits Index has increased impressively by nearly 18% year to date, indicating strong growth. In the first half, it contributed 15.55%. The median in Malaysia has risen by 14.44%, contributing 7.55% in the first half. It's important to highlight that our growth stocks in the Singapore market, yes, their growth is clearly outperforming value stocks. The Singapore Growth Index has impressively increased by nearly 50% year to date, reflecting strong economic trends. The increase in the first half exceeded 30%. Next, let's take a closer look at and analyze two representative indices that are prominent in the ASEAN stock market to better understand their performance and significance. One is the FTSE ASEAN All-Share Index, which includes all relevant stocks, and the other is the FTSE ASEAN All-Share Index, specifically excluding developed markets for a more focused analysis. Introduction to the two indices will follow. The FTSE ASEAN All-Share Index represents the diverse stock markets of 7 major ASEAN countries: Malaysia, Thailand, Vietnam, Indonesia, the Philippines, Brunei, and Singapore. The ASEAN All-Share Index excluding developed markets refers to companies listed in the 7 major ASEAN financial markets, excluding those from China, Hong Kong, and Singapore. It lists the stocks of its constituents. First, let's take a closer look at these 4 intriguing images. From analyzing these 4 distinct images, we summarize the key similarities and notable differences between these two indices. Firstly, we can see that the common point of these two indices is that the highest weighted industry is the banking sector, with a weight exceeding 30%. Secondly, in both indices, the top 3 countries by number of constituent stocks are Malaysia, Thailand, and Vietnam. The differences between the two options are just 2 key aspects. The first point to note is that when classified by individual country, the leading 3 nations by weight in the FTSE ASEAN National Index are Singapore, Thailand, and Malaysia. The second point is that, when classified by market capitalization, the top 3 by market cap in the FTSE ASEAN All-Share Index are Singapore, Thailand, and Malaysia. Next, let's look at the main differences between these two indices when classified by industry. Firstly, the common point is that in the industry classification, the highest net market value is also in the banking sector. The key difference is that in the FTSE ASEAN All-Share Index, the industry boasting the highest number of constituent stocks is notably the real estate sector. However, in the FTSE ASEAN Developed Markets Index, the industry with the highest number of constituent stocks is industrial products and services. At the same time, it is noteworthy that the top 3 industries by number of constituent stocks in both indices are. They include sectors such as real estate, various industrial products and services, as well as the food, beverage, and tobacco industries. Key similarities and differences exist between the two indices. Next, let's thoroughly analyze how the recent changes in the Federal Reserve's monetary policy significantly affect both the Southeast Asian market and the ongoing trends in the stock market. First, let's take a look at this chart. During the COVID-19 pandemic, we can clearly observe that the Federal Reserve implemented a series of unprecedented monetary easing measures to support the economy and stabilize financial markets during this challenging time. However, due to this easing, inflation in the U.S. rose rapidly, forcing the Federal Reserve to take aggressive rate hikes to combat inflation. During this ongoing rate hike cycle, which spans from March 2022 to July 2023, Both the ASEAN stock market and the US stock market exhibited a classic V-shaped recovery pattern, reaching their lowest point in October 2022, before rebounding significantly thereafter. In the context of a dollar-denominated monetary system, the exceptionally strong dollar has led to a significant influx of capital being directed back to the US economy. Consequently, in the context of increasing risk-free interest rates, stocks within the ASEAN region must provide higher returns to sustain a risk premium compared to the yields offered by US Treasury securities. If profits cannot expand effectively, it can only be achieved through a decline in valuations. In this regard, we can see that the banking and real estate sectors, which have a higher weight in the FTSE ASEAN All-Share Index, are significantly negatively impacted. These two sectors carry considerable weight within the overall market, meaning their downturn significantly influences the performance of the index. This explains why the ASEAN index has been experiencing a period of fluctuating decline, reflecting the challenges faced in these important areas. The market has shown weakness. When the US stock market officially entered a cyclical bull market in October 2022, it signified optimism. As we just mentioned, the ASEAN stock market did not rise alongside the US market, but instead entered a wide-ranging consolidation period lasting nearly a year. This reflects a relatively weak market performance. This is mainly due to the negative spillover effects of the Federal Reserve's aggressive rate hikes on the ASEAN emerging markets. The currency has depreciated several times. As the Federal Reserve reduces its rate hikes over the next 2 to 3 years, external monetary pressures on ASEAN diminish, leading emerging Asian markets to be among the first globally to halt rate increases. With the economy primarily relying on domestic demand, ASEAN gradually shifts towards an economic nurturing phase, reflecting changes during this turbulent cycle. In this specific context, when the Federal Reserve ultimately initiates a rate-cutting phase in September 2024, the resulting monetary easing will effectively alleviate the dollar's siphoning effect on the economy, allowing for improved financial conditions and potentially stimulating economic growth. Liquidity begins to spill over, providing some support to ASEAN stock markets, especially in the US. With the promising prospect of achieving a soft landing for the economy, the stability of external demand is effectively secured, thereby further strengthening and solidifying ASEAN's economic fundamentals. As a result, ASEAN stock markets experienced a strong rebound nearing the peak from early 2022. Now let's take a closer look at the Southeast Asian stock market from a detailed valuation perspective to better understand its current standing. First, when examining the price-to-earnings ratio closely, we can observe that the PE of the ASEAN index has experienced a significant and rapid decline since mid-December, ultimately dropping to a value of 1378. At what level? The market's price-to-earnings ratio has significantly dropped, indicating a potential shift in investor sentiment. It has unfortunately fallen below the opportunity level of 20%, which is significantly lower than historical averages and medians that we typically observe. This level. Likewise, regarding the price-to-book ratio, the index's PB ratio has swiftly decreased from 1.43 at the end of October to a lower value of 1.25, indicating a notable shift in valuation. By mid-December, it also fell below both the median and average levels previously recorded. It is just below the opportunity level. Let's examine the situation regarding volatility. This year, since 2020, the index has clearly demonstrated a notable characteristic of significantly low volatility. By December 13th, which falls in the middle of December, it becomes evident that the short-term volatility is on the rise, while the long-term volatility is decreasing, indicating a notable increase in overall market risk and uncertainty. From a long-term perspective, considering the clustering effect of volatility, we can anticipate that the ASEAN stock market may experience a shift from a low volatility to a high volatility environment. In summary, after carefully examining these three key directions, we can confidently assert that by the end of 2024, the Southeast Asian stock market is expected to enter a notable phase of undervaluation, characterized by a significant decrease in volatility, indicating a more stable investment environment. Now that we have thoroughly analyzed the overall situation of the ASEAN stock market, let's take a closer look at two representative member countries in more detail. The financial stock markets of Singapore and Malaysia are bustling. First, let's look at the situation in Singapore. In summary, it is anticipated that the Singapore stock market in 2024 will emerge as the best performing financial market in the entire Southeast Asian region. It can be seen that Singapore has a strong correlation with the US stock market. During the US interest rate hike cycle, the Singapore stock market diverged from the usual trend seen in the US, exhibiting persistent high-level fluctuations instead. Although the high interest rate environment has some indirect impact on investment and economic activities in Singapore, the relatively stable policy environment amidst rising global uncertainties has made Singapore a financial hub in Southeast Asia. It still draws significant safe haven investments. Singapore's stock market is strongly supported by the substantial profit growth of its listed companies in technology, energy, and real estate. From the perspective of the price-to-book ratio in Singapore's stock market, we can see that during this interest rate hike cycle, the PE has significantly declined. It has consistently been below its opportunity value. However, as the Federal Reserve enters a rate-cutting cycle, the PE has accelerated its recovery. As of mid-December, considering the FTSE Singapore Straits Index as a representative benchmark, its price-to-earnings PE ratio has notably risen above what is typically regarded as the opportunity value for investments. However, it still remains below the median and average levels. Let's take a much closer look at this. We will examine the performance of different types of companies in the Singapore stock market. From this chart, we can see that 22 years ago, the performance of growth stocks in the Singapore market was consistently better than that of value stocks. However, when the Fed entered the rate hike cycle, the situation completely reversed, with value stocks rising sharply while growth stocks plummeted. In Singapore, following the US into the rate hike cycle, growth stocks faced valuation pressure due to rising risk-free interest rates, leading to a downturn. However, after the Fed initiated rate cuts in September this year, both value and growth stocks in Singapore rebounded, supporting the market. From the performance of companies with different market capitalizations, it is evident that large-cap stocks have shown more stability than small-cap stocks after the Fed entered the rate-cutting cycle. From the detailed composition of the MSCI Singapore Index, we can clearly see that the financial sector, which holds the highest weight, exceeds a significant 50% of the total index. In fact, before the Federal Reserve's anticipated rate cuts, when the market had started predicting a decrease, Singapore's bank fixed deposit rates had already begun to decline. At the same time, mortgage rates also dropped significantly, indicating that Singapore's financial sector is more sensitive to changes in the Fed's monetary policy. Let's take a closer look at the overall performance and trends of the Singapore stock market industry today. As of the very end of December 2024, during this 6-month period, the highest gain was in the telecommunications sector, followed by materials, while the biggest drop was in utilities. Consumer discretionary leads in 3-month gains, with healthcare following closely, and in the past month, gains were strongest in finance and consumer staples. From the performance of the various secondary industries, it is evident that in the month leading up to the end of December, the sectors experiencing the highest gains were notably in healthcare, steel production, real estate development, and investment trusts, reflecting a trend of economic growth in these areas. In 3 months, home appliances and dining tourism led, while in 6 months, non-ferrous metals, media entertainment, and durable goods topped the sectors. It is evident that the distribution of industries in Singapore closely resembles that of the US stock market, showcasing similar patterns and trends in various sectors. Next, let's talk about the performance of Malaysia's market in 2024. In summary, The Malaysian stock market in 2024 is anticipated to rebound robustly, fueled by the Federal Reserve's anticipated interest rate cuts. By the end of October 2024, it has entered an undervalued phase. In comparison to Singapore's thriving stock market, which serves as a significant financial hub in the region, Malaysia's stock market appears to be relatively weak and less developed. During the Federal Reserve's rate hike cycle, Malaysia's stock market has remained sluggish, with wide fluctuations downward. The strong US dollar during the rate hike period led to capital outflows, increasing selling pressure and causing declines in the Malaysian stock market. The capital outflow pressures the Malaysian currency, leading to depreciation, higher import costs, reduced corporate profits, and a negative impact on the stock market. After the Federal Reserve's interest rate cuts in September, the Malaysian stock market aligned with the rising trend of the US market. From a comprehensive narrative perspective, we can clearly observe the current PE ratio of the FTSE Malaysia Index in greater detail. As of mid-December 2024, it has rapidly declined to a level of 14.88, which is significantly below the opportunity value level. Let's examine how companies with various characteristics perform. We can observe that after the Federal Reserve began cutting interest rates, in contrast to the strong and robust rebound of value stocks, Malaysian growth stocks have unfortunately remained sluggish and underperforming. From the perspective of market capitalization, during the recent period of rate cuts implemented by the central bank, both large cap and small cap stocks have exhibited a notable upward trend. Unlike during the COVID-19 pandemic, when small cap stocks displayed considerably greater volatility, large cap stocks only exhibited a consistent downward trend. After the Fed entered the rate cut cycle, the performance of large cap and small cap stocks became more consistent. Similarly, when examining industry performance in Malaysia, we can observe that the highest gaining sector so far this year is still the utilities sector, followed closely by the information technology sector, which has also shown significant growth. In the last 3 months, healthcare and consumer discretionary sectors performed best, with information technology leading gains in the past month. It can be clearly observed that both Singapore and Malaysia prominently showcase the industrial sector as the most represented and significant sector in their respective markets. This is one similarity between the two markets. Having reviewed the performance of the financial markets, let's look ahead to the Southeast Asian market in 2025. First, what specific kinds of changes can we realistically expect in the Southeast Asian market by 2025? We all recognize that, as discussed in previous content, Southeast Asia, or ASEAN, possesses a significant long-term fundamental advantage. This includes a young and abundant demographic dividend, a large domestic consumption market characterized by a focus on domestic demand, and a relatively low per capita GDP with a high level of urbanization. Furthermore, we can assert that the current ASEAN countries now have significantly enhanced self-defense capabilities, reflecting their growing military strengths. First, let's take a closer look at this important development. In 2020, significantly impacted by the widespread COVID-19 pandemic, ASEAN countries began a concerted period of monetary policy easing aimed at revitalizing and restoring their economies to promote recovery. However, since the onset of the Russia-Ukraine war in the first half of 2022, which severely disrupted the global supply chain, several ASEAN countries have encountered considerable challenges related to imported inflation, leading to increased prices for goods and services that impact their economies. To effectively stabilize domestic price levels, several ASEAN countries have decided to implement a tightening monetary policy cycle to combat inflationary pressures and maintain economic stability. For instance, from the second quarter all the way to the end of 2022, the central banks of Indonesia and Vietnam collectively raised interest rates by a substantial total of 200 basis points, while the Central Bank of the Philippines significantly increased rates by as much as 350 basis points during the same period. Next, let's look at the inflation situation. Under the significant impact of the ongoing global inflation crisis, the inflation rates in ASEAN countries, particularly the Consumer Price Index, CPI, reached their peak during the fourth quarter of 2022 and the first quarter of 2023. Cambodia and Thailand reached their peaks even earlier. From the first quarter of 2023 to 2024, influenced by the tight domestic monetary policy and the decline in global commodity prices, inflation rates in ASEAN countries gradually fell and remained at a relatively stable level. They have returned to or are below the central bank's target range. As of the latest data, Singapore's inflation rate stands at 1.4, which is below the Monetary Authority of Singapore's expected target. Malaysia has a relatively low inflation rate. It has remained around 1.8% for 3 consecutive months, also below the central bank's projected range for domestic inflation in 2024. From the perspective of the important policy goal of effectively curbing inflation, Singapore and Malaysia currently meet the necessary conditions to relax their monetary policy. Upon examining the current economic recovery situation, it is evident that, at this moment, most ASEAN countries are experiencing economic growth rates that are remarkably close to the levels seen before the onset of the COVID-19 pandemic. The impact of COVID-19 had caused ASEAN countries to generally fall into an economic recession crisis since the second quarter of 2022. After significantly relaxing control policies in 2022, economic activities in ASEAN countries gradually returned to normal. By early 2023, economic growth rates in most ASEAN countries were nearing their pre-pandemic 2019 levels. Only Thailand has not fully recovered. From the perspective of stimulating overall economic growth, Thailand, the Philippines, Vietnam, and Indonesia each have a greater likelihood of relaxing their monetary policy measures in the short term. To summarize, one of the key factors significantly affecting ASEAN countries in 2025 is their own national defensive capabilities, as many member states have notably relaxed their exchange rate policies, allowing for greater economic flexibility and potential resilience against external shocks. Inflation rates are slowly declining and stabilizing at relatively steady levels. Thirdly, the economic growth rates of most ASEAN countries are now returning to their pre-COVID levels, indicating their strong defensive capabilities against global economic challenges. Relatively stable. The second significant factor impacting market growth in the year 2025 is the issue of monetary stability, along with the ongoing pressures related to exchange rates. In response to economic conditions, the Federal Reserve has decided to postpone any potential interest rate cuts until September 2024, which may influence investment strategies and overall market confidence during that time. This unexpected delay has not only strengthened the US dollar index significantly, but also caused a notable depreciation of several ASEAN currencies. By May 2024, the currencies of the Philippines, Thailand, and Vietnam have depreciated by 5% or more, while Singapore and Indonesia have also seen varying levels of depreciation. From the perspective of stabilizing their national exchange rates, Malaysia, Thailand, and the Philippines are likely to continue maintaining their current interest rate levels for the foreseeable future. A slight interest rate increase may be considered to slow the rapid depreciation of the national currency. However, Singapore, Vietnam, and Indonesia still have some additional room for further monetary policy easing measures. It's important to highlight that while we suggest the flexibility of the monetary policies in ASEAN countries may improve following a decrease in interest rates by the Federal Reserve, if the underlying issue of currency depreciation risk continues to be unresolved, the demand for foreign capital as a hedge against such risks will likely persist, presenting an escalating challenge for these economies. This is the second factor affecting the Eastern European market in 2025. The third important influencing factor in this context is the overall purchasing power of consumers. First, we observe that the real purchasing power in Southeast Asia and the ASEAN region has effectively returned to levels seen before the COVID-19 pandemic. From this chart, we can see that after the Fed entered the interest rate hike cycle in early 2022, the year-on-year growth rate of M1 money supply in most ASEAN countries declined. Notably, Singapore experienced a more significant and pronounced decline in its year-on-year growth rate compared to previous periods. Specifically, by March 2023, the growth rate of Singapore's M1 money supply had only just recently ceased its previous decline, indicating a potential stabilization in the economy and a shift in monetary conditions that could influence financial activities and consumer behavior moving forward. It had dropped for 11 straight months before. However, it recovered remarkably quickly, and by September of that year, it had returned to economic levels similar to those of most Eastern countries. Malaysia's economic growth rate rebounded impressively in May 2023, surpassing that of neighboring Singapore. ASEAN countries are managing domestic inflation by lowering the growth rate of their money supply, specifically M1, which encompasses cash, demand deposits, and other deposits circulating within the economy at a given time. By strategically lowering this growth rate, they aim to effectively manage and control domestic inflation levels. When the inflation rate peaks and recedes, the growth rate of the money supply will rebound. To stimulate this economic activity, after the year 2024, the majority of ASEAN countries are expected to experience a year-on-year decline in M1 growth, with Thailand standing out as the only exception, as it will show a notable increase. In response to the repeated delays in the Federal Reserve's interest rate cuts, ASEAN countries are continuously adjusting the supply of M1 to counter the risks of currency depreciation due to a strong dollar. As of October 2024, the M1 money supply in various countries has notably returned to its pre-COVID economic levels. Examining the current situation regarding M2. Reducing M2, which refers to the broader money supply, is widely regarded as an effective measure to combat rising inflation by deliberately slowing the overall growth rate of the money supply. The measure effectively curbs rising prices and ensures price stability. Generally, such measures help stabilize market expectations and boost consumer and business confidence to promote healthy economic development. It can be clearly observed that the majority of ASEAN countries demonstrate a consistent upward trend in year-on-year economic growth, while Indonesia unfortunately continues to experience a decline. Aside from that, in addition to Indonesia, other countries that are reducing their M2 money supply include Malaysia and Thailand, whereas Singapore and the Philippines have notably increased their M2 money supply. The inflation levels in these two countries have significantly decreased from their previously recorded highs, as we can clearly observe from the earlier chart that illustrates this downward trend effectively. Looking back at the overall market performance over the past year, we can clearly see that during the Federal Reserve's rate hikes, the emerging market contagion effect caused the financial markets in Eastern countries to be undervalued, with significant capital outflows. This indicates that a large number of investors indiscriminately sold off their funds in both ASEAN countries and other emerging markets across the region. This is also why the correlation between the two variables is quite strong and significant in various contexts and studies. By October 2024, besides Malaysia's M2 continuing to decline, Singapore's M2 growth rate has significantly rebounded. M2 money supply growth rates in multiple countries have stayed stable for several months, near pre-pandemic levels. This indicates that although the impacts of capital scarcity and market contraction in ASEAN countries continue to be present, there are signs that the overall situation is gradually improving. As we mentioned earlier, M1 indicates that the real purchasing power of consumers has returned to pre-pandemic levels, while M2 reflects the potential purchasing power available in the economy. The situation is improving, though it remains in the recovery phase. Now let's take a look. The next important factor affecting the Southeast Asian market in 2025. One significant factor contributing to the situation is the ongoing great power competition between nations. Definition of great powers. These are the two countries that have the greatest impact on the Southeast Asian market, the United States and China. Firstly, we assert that the Federal Reserve's interest rate cuts will require some time to significantly influence capital flows in the economy. We anticipate that Singapore and Malaysia's Southeast Asian stock markets will be significantly influenced by the Federal Reserve's rate-cutting cycle throughout the entirety of 2025. In the short term, the rate cuts lower the cost of dollar financing, helping to ease external pressures and attract some capital to emerging markets. The future performance of Southeast Asian stock markets hinges on the resilience of regional economic growth and effective policy responses. The market now generally anticipates that the Federal Reserve will likely slow down its planned rate cuts in the near future. However, the Federal Reserve, along with Donald Trump, who will be our next president, is set to take office later this month, marking a significant transition in leadership. After Trump takes office, his new policies will still carry some uncertainty. This growing uncertainty may lead to significant fluctuations in the dollar index and U.S. stocks, which could subsequently impact Southeast Asia's exchange rates and stock markets as well. Overall, the central banks of the various ASEAN economies may likely decide to follow the Federal Reserve's decisions regarding interest rate cuts in order to align with global economic trends. This development could significantly benefit capital inflows into ASEAN's diverse stock markets, consequently improving the overall outlook for their various assets. Next, let's discuss the China-US trade conflict. This is also a short-term positive factor for ASEAN. Initially, as previously mentioned, a significant 77% of the ASEAN market is primarily driven by robust domestic demand from within the region. Under this particular characteristic, ASEAN's overall influence on global trade dynamics is relatively low when compared to other major economic regions. In the remaining trading activities, approximately 23% of the total share is dedicated to trade, with a substantial 80% being intra-regional trade, while the US accounts for only 10%. So, if Trump decides to impose specific restrictions on tariffs after officially taking office as president, and if this situation leads to a significant decline in China's market share in the US market, it does not necessarily mean a complete or absolute return of manufacturing operations back to the US from other countries. On the contrary, this may lead manufacturers like China to seek more suitable regions as their main production bases. For example, he can choose to engage in trade with ASEAN countries in the remaining 80% of the total area available. Considering ASEAN as a viable production base could significantly foster positive market expectations and enhance trade opportunities within the ASEAN region. All right. We are just about to reach the crucial final part of our comprehensive asset allocation strategy. To begin with, in terms of asset allocation strategy, let's take a moment to thoroughly review the key main points we've previously discussed in our meetings. I have summarized my core points here for everyone to browse. Overall, let's concentrate on the circumstances we expect in 2025. Firstly, as we look ahead to the year 2025, the anticipated interest rate cuts by the Federal Reserve will significantly impact Southeast Asian stock markets. With resilient economic growth and a well-crafted monetary policy, implementing rate cuts will significantly lower USD financing costs, which will ease external pressures and attract some capital into emerging markets, thus improving the overall asset outlook for investors. Future uncertainties persist about the Federal Reserve and Trump's policies. This may lead to fluctuations in Southeast Asian exchange rates and stock markets, while the US-China trade conflict will also be a favorable factor for accelerating the Eastern economy. Driven by economic growth targets, the attractiveness of green energy, digital economy, and high-growth industries is expected to become a key indicator for capital flow in ASEAN. which we refer to as Southeast Asia's major asset allocation. Whether the attractiveness of ASEAN stocks can be enhanced depends on three key factors. One important consideration is whether the decrease in capital costs can effectively lead to actual financial flows. The transmission path of the Federal Reserve's interest rate cuts to capital flows still needs time to materialize. However, given the current geopolitical situation, the ASEAN countries possess a strong self-defense capability, indicating that the fundamental aspects of the regional market remain relatively robust and stable. Following interest rate cuts, ASEAN countries may experience greater monetary policy flexibility due to stable currencies and exchange rate pressures, but they still face risks of currency depreciation. Thirdly, regarding industry development and long-term yields, we refer to major asset allocation. From the perspective of the economic growth goals promoted by ASEAN countries, sectors like green energy and the digital economy are highly attractive. These may become key indicators for future capital flows. Now, let's take a closer look at the historical trends associated with mainstream institutional momentum exchange-traded funds, ETFs. This overview aims to provide everyone with a brief but informative understanding of which prominent mainstream institutions have successfully issued ETFs specifically related to the dynamic Southeast Asian market and its evolving investment landscape. Furthermore, let us take a closer look at the historical capital flows within the Singapore market categorized by various industries for a better understanding. In this section, we have carefully listed a total of 6 detailed charts, each displaying a comparison between 2 distinct industries. It is quite evident that, with regard to capital flows, the sectors of energy, finance, industry, and utilities stand out as the most prominent and significant contributors in this analysis. Everyone can gain a brief yet useful familiarity with the current situation in the rapidly evolving Southeast Asian market. This understanding can help individuals grasp the key trends, opportunities, and challenges present in this dynamic economic landscape. By taking the time to become acquainted with the market's characteristics, one can better appreciate the potential for growth and investment in the region, as well as the unique cultural and regulatory factors that influence business operations in Southeast Asia. Right, that officially concludes the complete content of this live broadcast session. Thank you for joining. Next, let's take a moment to see if there are any questions from everyone present as we transition into the Q&A session. This is an excellent opportunity for all participants to seek clarification or share their thoughts on the topics we've discussed. Please feel free to ask anything that might be on your mind, and I will do my best to provide thorough answers to ensure everyone leaves with a clearer understanding. I firmly believe that everyone discovers the Southeast Asian market to be quite refreshing and vibrant when compared to the more established markets of the US and Europe. Through this engaging live broadcast, I sincerely hope that everyone can gain a deeper and more comprehensive understanding of the unique opportunities and dynamics present in the Southeast Asian market. All right, that wraps up today's engaging live broadcast. Thank you all sincerely for tuning in and watching. We truly appreciate it.